Today is April 18, 3:38 p.m. We saw some unusual options on UAA, that's Under Armour. And if you look at it recently, it's been trading at about this $9 range. You'll see here. So will it go up or will it go down? Keep in mind, earnings is actually more like a month away. So as we look at these unusual options, let's see what it tells us. So at about 212, you'll see all these here. And then also the 1229. All of these contracts, all very similar because it's all the May 12s and the April 28s, and it's all for the 9 strike calls. So that's quite interesting because if we look at it, here that is the 28th of April. Here they are, the 9 strikes. You'll see that there's 7,000 of these today. And we also are in this position. We sold it and less than the open interest. So we know these are open orders. And also for May 12, it is also 7,000, which is more than the open interest. We are also in the position. And this one is buying the 9 calls. So this is a calendar spread. And so what they're doing here is actually quite smart, because a calendar spread actually takes advantage of an increase in volatility. So as the volatility increases, the trade will actually be profitable. So you'll see here in the Greeks, this is a positive vega, right? And it's also a positive theta. The theta will become negative if it starts to move quite substantially. You'll see here if it goes down 10% or up 10%. And so as long as it stays around this range between 8.7 and 9.2, this will be a profitable trade. And what we think is that because this volatility is historically very low, if we look at it here, today's options, this is at 1%. The current historical volatility percentile is pretty low. That's why they're doing this calendar spread, because as we approach earnings, which is in, as we looked at, about a month away, as we approach this earnings, volatility will be increasing, as we all know. That mostly always happens before earnings. And so that's when they will probably take their trade off, because it does expire before earnings. Their latest expiration is May 12, but they'll probably start taking it off on April 28, because that's the first leg of their option trade will expire first. So that by in 10 days, this trade should be profitable. And so we'll be watching for that. It's currently selling for $30 each. So you can position size it based on how much risk you want to take. But this is quite an interesting trade, given that this stock has been trading kind of sideways for the past few days. And doesn't look like there is much activity at this moment. So the volatility has gone historically down to just 1%. So that's quite low. And so you want options trades that take advantage of low volatility. Okay, well, I hope this was helpful and you learned something. Please smash that like button and we can keep making videos. Subscribe and hit the bell icon and you'll be notified when we see unusual options. Take care, everybody.